And we're back on the Lance Roberts Show podcast today at realinvestmentadvice.com with Jeffrey Sherman from Doubleline. Jeffrey, just before the break, we were talking a little bit about the economy. We've seen some slowing in some of kind of your big parts of the economy. We've seen a slowing in auto sales. We've seen a slowing in a lot of the housing data because, interest rates had ticked up last year. And what's interesting there is we also talked about the impact of the amount of debt and leverage that we have in the economy. And so it was interesting to see a very small rise in mortgage rates had an immediate, almost negative impact. Well, not just almost immediate, had a negative impact on housing sales and mortgage applications, et cetera. People simply saying, I can't afford the higher payment, or I'll just wait to see if it comes back down again. I think it's a little bit of a function of both. But y'all run a very successful real estate fund, at Doubleline. Can we talk a little bit more about what you're seeing in the housing market in relation to that fund?
Yeah, let me start with your auto comment too. And the auto sales have been weakening for really about 7 or 8 years. And I think with Hurricane Harvey, you got this big bump back up
Right.
in auto sales that was really from insurance payments and replacement of autos during that. So I think that's not something that's materialized based off of higher rates, but that's just a structural change in the economy. I think that's something to do with the ride share and really just kind of the newer type of economy where people have been desiring more urban type of living and being together.
Yeah, it couldn't have anything to do with the fact they're having to finance cars for 8 years to get people to afford them.
Yeah, I mean, it is pretty expensive out there when you look at the price tag of some of these things. Even used cars are very expensive too.
They
and
are.
So, I think that, and also remember, cars last longer.
Yeah, right.
The good news is they're more reliable. The bad news is that's bad for turning over car sales. But
See, John, that Model T you're driving, it's still got life in it.
you can have it any color that you want as long as it's black. Right,
Right, exactly.
But ultimately, talking about the housing market, it is very interest rate sensitive because the affordability of some of these are predicated on low interest rates. And it depends on the region that you're talking about. But I think it is affordability at the end of the day. And sometimes you get a last push when rates start to push up where people think, I just got to get in because ultimately I won't be able to afford it if rates go any higher than here. But you've seen rates come down a little bit. I don't expect that to spur massive supply or massive buying spree within the housing market because again, the prices are relatively high. Sure. And we've had one of the best 5-year runs in housing that we've had historically. And so coming off the bottom in 2012, this has been one of the fastest rise in residential real estate in a long period of time. And you were mentioning the real estate fund that we run. Mm-hmm. That's actually focused on real estate investment trusts. So these are publicly traded REITs that look at various sectors of the REIT market.
So a lot of apartments, industrial, retail, even data, healthcare, data centers,
That's right.
cell tower, real estate, all kinds of things like that.
Right. So you start off with the traditional things that people know. People think of apartment buildings, or we call multifamily housing. They think of strip malls, and people say, why would you want to buy strip malls in middle America? Because people still go to them, actually.
Right.
But further, I think what you mentioned is quite interesting, is that the structure, and it's primarily due to some kind of tax benefits of the structure, people have been using it outside of traditional kind of mechanisms. And you mentioned the hospitals, you talk about cell phone towers, e-commerce. There's a lot of things that are tied into the new economy that are using the real estate investment trust structure, mm-hmm. Which we think is a good opportunity going forward. So although the traditional or the kind of core properties that you talk about, they used to comprise roughly 80% of the REIT universe. Today, they're less than half of the REIT universe today. Yep. So what we ended up doing was partnering with an entity, or we essentially licensed their intellectual property. They came up with a smart beta way of investing within the REIT structure. And what they did is that they are REIT providers. Their name is Colony Capital. Mm-hmm. They run REITs. They're familiar with it. They've done a lot in the private markets over the last 20 plus years. But what they did is they said, the rules and the way we approach it, we can write these down systematically. And there's a lot of mistakes that are made with people overpaying for assets in the REIT markets, focusing solely on yield in the market. How many times have you heard that one, John?
Yes.
Right? It's yield, yield, yield.
And we should say
individual sign of stress.
Yep.
Right? Just like the bond market. Mm-hmm. And so as we talked with them about their methodology, it really, really resonated with the way we think about managing money. Avoid the toxic situations. Right. Avoid the highly levered companies. Avoid the ones where the dividend is signaling trouble, right? Avoid the ones that are expensive. And if you just do that and invest in the rest of the universe, what that ultimately leads you to is a better profile throughout the market. Mm-hmm. So you'll see a slight lag in a very aggressive upward trending market, but in a moderate growth market in the REITs to a downward market, we see that historically this index would have outperformed. And so it's something that we did similar to our equity structure, where we get this index, we do it through swap, and we invest in a portfolio of bond securities to try to outperform the financing spread on that. And so far, it's been a pretty successful product. We've only had it for about 3 months or so, but we've raised about $115 million to date. And, it's up in the double digits here to date.
Yeah. And we should mention that in the real estate space, in the REIT space, REITs have to pay out 90% of their net income as dividends. And so there's a lot of yield chasing that occurs in the REIT space as it does in the bond market, people chasing junk bonds. And so it sounds like you're sacrificing some of the yield, but you're choosing, as a result, a higher quality property portfolio overall.
That's right. Yeah. And, the old story about real estate, I think you joked with me at one time, is location, location, location.
Sure.
And it's true. Flagship properties are flagship properties for a reason. Yeah. But there are no, a 10x multiple growth stories in the real estate market, mm-hmm. right? You're not going to buy a piece of property for 10 grand and flip it for 100, right? Maybe in Detroit back in the crisis, right. You could have done that, right? But ultimately, those stories don't exist in these publicly traded markets over the long term. So the key here is to focus on core assets, high quality assets, sure. where you can raise rents to the cycle. Land values could also appreciate with inflation, as Lance had been asking me about inflation coming. If you get it at least over time, your rents and land values can also rise commensurate with inflation. And if you have an overall robust economy, you're able to continue to raise rents throughout this cycle too. So we think it's an interesting product. REITs have underperformed the S&P 500 or had for the last 4 years, and they just look a lot cheaper than a lot of parts of the overall U.S. equity market. And so from a timeliness perspective, we thought it was interesting. Obviously, they moved a lot year to date with the performance of risk assets in general. But to us, this is a long-term trend and just another strategy we want to put in our asset allocation suite for investors out there.
So basically what you're saying, Jeff, is you're not buying properties in Cut and Shoot, Texas.
I have to admit, I don't know if we own any there because it's a systematic strategy. But secondly, I will also admit I do not know where that's at.
And neither does anybody else. And that's quite all right. I do have one question, though, in regards to REIT. What's the risk? A lot of people are buying REITs because of yield. They are doing the yield chase, but what's the big risk that potentially negatively impacts REITs in the future?
Yeah, I think REITs have historically, because it's a single sector of the equity market, they exhibit higher volatility than a broad-based index, something like the S&P 500. So if you think of the S&P 500, whatever you think the volatility is, that slap a 30 to 40% increase on the risk. And that's what REITs are. You're investing in one single sector of the market, mm-hmm. just like if you invested in technology, right? Yeah. You expect more risk. But it's going to be tied to the overall macroeconomic economy. So, if you go into a recession and you have a curtailment of investment slowdown, it's going to have an impact on the REIT market. So it's another way of focus on the economy. But there's been so much money chasing the private sector of real estate for the last, 5 or 6 years. And in fact, there's so much cash trying to get invested in these public sectors, in the private sector, mm-hmm. that it's made the public sector look very cheap. And so another way of thinking about, kind of the overall REIT market is that, on a valuation basis, the public market actually is much cheaper than a private market today, which you normally don't get that throughout many points in the cycle.
Right.
But ultimately, the risk here are the U.S. economy. These are primarily U.S. assets, and so that is the big focus here. But again, if you think that you have stability of contracts, you think that people can survive through the recession, your rent money is somewhat guaranteed, right? Unless they go out of business. So that's really the big risk people face, is the inability to make those timely rent payments, because that's what you're doing. You're renting out property at the end of the day.
Right. Well, Jeffrey, thank you so much for your time today. Is there anything that John and I didn't ask you that was an important point that you wanted to make?
I think we covered a lot today, so I'm going to take the obligatory, you covered it all today.
We wore you out.
Exactly.
All right. Yeah. Wore me down as you should. So thanks a lot for your time. Thanks for having me on today. I really appreciate it.
We appreciate you coming,
Absolutely.
Jeffrey.
Thank you so much. That's Jeffrey Sherman from Doubleline. And of course, you can get this entire podcast at our website. Simply go by realinvestment.com and subscribe to our YouTube channel. And we are going to provide these in segments, but you can also get the entire interview in its entirety at our website and our YouTube channel at Lance Roberts Show. Have a great day. We'll see you next time on the next edition of Lance Roberts Show right here at realinvestmentadvice.com.
Lance Roberts blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's a rich man's world.